Hi everyone, in this video we'll be going over A-Level Accounting 2023 October-November Paper 3-2 question number 3. This is the structured paper 3 which consists of 3 questions. Each of them will be of 25 marks and the total time limit given for this paper is 1 hour and 30 minutes, which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question 3 under 30 minutes. So without any further delay, let's get started. TG plc is an expanding company with a financial year end of 31st December. A junior member of the account staff took the statements of financial position of the company at 31st December 2022 and 21 and prepared the following draft statement of cash flows. We are starting with profit for the year, which is incorrect. This should include profit from operations. Then we have the increase in property, plant and equipment. So this is an increase in asset, but we're not considering the non-current asset because non-current asset should not be a part of our operating activities section. This should be a part of our investing activities section. So this is incorrect as well. Then we have the increase in inventory, and the increase in asset will always lead to cash outflow, which is why we need to subtract it. In this case, we have subtracted 14,000. This is correct. Then we have the increase in trade receivables, which is again an asset and it is being subtracted. So that's correct as well. Then we have the increase in trade payables, which is the increment in liability, and the increment in liability will always result in cash inflow, which means that we need to add it. So in this scenario, this is correct as well. Then we are given the increase in tax payable. This is incorrect because we do not include the increase in tax payable. We have to include tax paid. So we have to make an adjustment for this. Then there's the decrease in interest payable. Again, this is incorrect. We do not include the decrement in interest payable. We include the interest paid. Then there's an increase in long-term bank loan. So increment in the long-term bank loan, again, we're considering liability. Increment in liability will lead to cash inflow, which is to be added, which is added in this case. But this should be shown within our financing activities section. Then there's increase in ordinary share capital of 400,000. Okay, then there's the increase in revaluation reserve as well. So revaluation reserve will increase only when there is an increment in our non-current asset. So we need to process this information as well. Then there's the decrease in share premium of 250,000. And remember, for the increment in ordinary share capital and decrement in share premium, these can be done through bonus issue as well. But bonus issue will not lead in any sort of cash inflow or outflow because we are funding all of the bonus issue of shares using our reserves. So no cash is going out of the business and no cash is coming into the business. So we need to exclude the bonus issue changes from our increment in ordinary share capital and the decrement in share premium. Okay, then there's the dividend paid, which is to be subtracted because this results in cash outflow, but this should be subtracted within our financing activities section. And we are given the bank balance at 1st January 2022 and bank balance at 31st December 2022. All right. Further information is available as follows. The statement of profit or loss showed a tax charge of 32,000 and a finance expenses of 15,000. Okay, so the first thing that we need to do is figure out the profit from operations. And remember, profit for the year, we start with profit from operations. We subtract all of our finance costs as well as the tax. And in this case, we are given the profit for the year to be 76,000. We're trying to figure out the profit from operations. We're given the finance expenses or finance cost of 15,000. That's the interest charges. Then we have the taxation of 32,000. Okay, this will give our profit from operations to be 76,000 plus 15,000 plus 32,000. Which is also the value of 123,000. So we will start with our cash flow statements from our operating activities section, and the first item will be the profit from operations. Okay, and remember, we also need to figure out the tax paid and interest paid rather than the increase in tax payable and decrease in interest payable. Okay, let's first calculate the tax paid. We start with the tax charge within our statement of profit or loss of 32,000. Then the adjustment is pretty simple. So we follow the same rule. If there's an increment in our asset, we will subtract it. That results in a cash outflow, right? And if there's a decrement in our assets, then we consider it to be cash inflow. That's the same rule we are applying here as well. And in this case, we have increment in tax payable. This is a liability. which should be added in case of our statement of cash flows. But since we are starting with the amount given in statement of profit or loss, the adjustment would be exact opposite. So if it is to be added here, it should be subtracted from here. So that will be minus 6,000. And this is subtracted because there is an increment in the tax payable amount. So 6,000 of tax is yet to be paid. So out of 32,000, 6,000 is yet to be paid, which means that the actual cash outflow resulting from the tax payment is going to be the difference of these amount, which is 26,000. So out of the total of 32,000 tax charge, we have only paid 26,000 and there is still tax payable of 6,000 left. We can then repeat the same process for interest paid. So we start with the amount of interest given in our statement of profit or loss, which is 15,000. And in this case, we have a decrement in interest payable, which is to be subtracted within our statement of cash flows, but the opposite would be true in order to figure out the interest paid. So we'll be adding 3,000. This is because despite the finance cost being only 15,000, we made an additional prepayment of 3,000 as well. So the cash outflow was 15,000 as well as the additional 3,000 prepayment for the next year. So the total cash outflow resulting from the interest paid will be 18,000. Okay, I think that's all for the first information. Then share capital consists of ordinary shares of $1 each. That's our nominal rate. 2 share issues were made during the year, and the first was bonus issue. And remember that bonus issue does not result in any cash inflow or outflow, so the increment or decrement from bonus issue should not be included within our statement of cash flows. And the bonus issue was of 300,000 shares, which was funded entirely from the share premium. Okay, so this we cannot include it. Then the second was a rights issue of 100,000 shares at a premium. Okay, so we can include it. Now, the increase in share capital resulting from our rights issue will just be the number of rights issue shares multiplied by the nominal rate, which in this case will be 100,000. So there's an increment of 100,000 in our share capital. Then we need to figure out the same thing for our share premium as well. And in this case, we were told that the bonus issue of 300,000 shares was funded entirely from the share premium. So initially, we had the amount of 300,000 from the share premium account, right? Then there was a rights issue premium. And the decrement amount is now 250,000. So we can solve this equation and figure out that the rights issue resulted in the share premium of 300,000 minus 250,000, which results in 50,000. So there's an increase in share premium of 50,000 due to rights issue. And we will be considering rights issue because the amount of 100,000 as well as 50,000 will be paid into the company by our existing shareholders in order to buy these new rights shares. Okay, that's all for the second information. Then the new machinery of 348,000 was bought. Motor vehicles with a carrying value of 56,000 was sold for 71,000. Okay, let's have a look at the disposal first. We can figure out whether or not there was a profit or loss on disposal. We can see our net book value is 56,000 and the amount that we got for disposal is 71,000, which is higher than our net book value. This results in a profit on disposal. That is just going to be the difference between the sales proceeds of 71,000 and the carrying value or the net book value of 56,000, which results in the amount of 15,000. That's our profit on disposal. Then we also need to figure out the depreciation charge for the year. And in this case, I think it will be better if we utilize our schedule of non-current assets. I'll just write down the format here. We start with the opening net book value of our non-current asset. Then if there is revaluation upwards, we add it. If there's revaluation downwards, we subtract it. And we only subtract the revaluation upwards or downwards amount. Then if there is any purchases, we add it. And the purchases is to be added at its cost. Then if there is any disposal, we subtract it. And the disposals are to be subtracted at its net book value. Then we subtract the depreciation charge for the year. And after adjusting all of these, we get the closing net book value. So again, we repeat the same process in this case. But we are not given the opening net book value or the closing net book value. Instead, we were told that there is an increment in the property, plant, and equipment. So increment just means that our closing value was greater than the opening value by 472,000, right? So this is just the closing net book value minus opening net book value. That's 472,000. Now we can start with the equation. We just brought this to the other side. We can start with the revaluation upwards. There is a revaluation upwards because we are given the increase in revaluation reserve, which only happens if there is revaluation upwards. So that's of 300,000. There is no revaluation downwards. There is the purchases of new machinery. So we need to add it. That's 348,000. Then there's the disposal of our motor vehicles, and we need to subtract the net book value, which is 56,000. We are trying to figure out the depreciation charge for the year, and this will be equal to the closing net book value minus the opening net book value, which is 472,000. So the depreciation charge for the year is just going to be 300,000 plus 348,000 minus 56,000 minus 472,000, which results in 120,000. Okay, that's all for the third information. Let's take a look at our question. We need to prepare the corrected statement of cash flows for the year ended 31st December 2022 in accordance with International Accounting Standard 7. Okay, this is for TG PLC. We are preparing the statement of cash flows, and this is for the year ended 31st December 2022. Okay. We first start with our operating activities section, and within our operating activities section we can start with profit from operations, which we have already figured out to be 123,000. Okay, then the next thing that we need to do after including the profit from operations is we need to adjust for any non-cash expense, and the non-cash expense is depreciation. And we are excluding the depreciation because depreciation does not result in any sort of cash inflows or outflows. But while figuring out profit from operations, we used to subtract the depreciation. Now we just need to reverse it by adding the depreciation amount. We've already calculated the depreciation amount to be 120,000. Now we just need to add it. So that will be depreciation of 120,000. Then the next thing we need to adjust would be the profit or loss on disposal, because these relate to our non-current assets, and any non-current assets related items should be actually included within our investing activities, not the operating activities. And profit on disposal was added while figuring out the profit from operations, which is why we now need to exclude it. So we need to reverse the entry. So we will be subtracting the 15,000. Let's write it down. That's profit on disposal. We need to subtract it. Then the other adjustments for increment and decrement in our current assets and current liabilities were correct. So we can just copy down those entries. We have the increase in inventory of 14,000. We have increase in trade receivables of 19,000, and we have increase in trade payables of 11,000. After adding these, we can figure out the cash from operations. So we can start with increase in inventory. Which was of 14,000. We need to subtract it since this is an increment in asset. Then there was the increase in trade receivables, which is again the increment in assets, so we need to add it. And this was of 19,000. Then there was increase in trade payables, but this is the increment in our liabilities, which means that this results in cash inflow. So we need to add it. That was of 11,000. Now, after adjusting all of these, we'll get our cash from operations. Okay, let's calculate it. That's going to be 123,000 plus 120,000 minus 15,000 minus 14,000 minus 19,000 plus 11,000, which results in 206,000. Now the next step would be to make adjustment for tax paid and interest paid. So we've already calculated the amounts. We just need to subtract it now. And we're subtracting it because both of these are the payments, which results in cash outflow. Okay, so the amounts are 26,000 and 18,000. Now, after adjusting it to the cash from operations, we can get our net cash from operating activities. That will be 206,000 minus 26,000 minus 18,000, which results in 162,000. Okay, now we can move towards the second section, which will be our cash flow from investing activities, where we are concerned with non-current assets. So the first thing is that there was the purchase of non-current assets, 348,000. And in order to make this purchase of new machinery, the company will have to pay out 348,000. So this will be our cash outflow, which we need to subtract. So we can write it under the heading of purchase of machinery. And this was of 348,000. Okay, and we also have disposal. So after disposing the motor vehicles, we received an amount of 71,000. So this is the cash inflow for the business. We need to add it. We can write it under the heading of sale of motor vehicles. That was of 71,000. And that's all for our investing activities. So we can just add it and figure out the total for net cash from investing activities. That will be minus 348,000 plus 71,000, which results in negative 277,000. Now we can move towards our final section of our financing activities. So financing activities is concerned with our capital and liabilities movement. And in this case, we've already figured out that there was an increment in share capital of 100,000. This is a cash inflow, and increment in share premium of 50,000, which is again a cash inflow. So we need to add these two amounts. Let's write it down. So increase in share capital of 100,000. Then we have the increase in share premium of 50,000. And we're also given information regarding loan. Okay, we are done with these information. There's an increment in long-term bank loans. So we acquired more loan, which means that this will act as our cash inflow. We need to add this amount of 30,000 as increment in loan. Okay, then we've included the increase in ordinary share. We included the increase in devaluation reserve while calculating our depreciation. We've adjusted the share premium. Then there's dividend paid, which is also a part of our financing activities, and this will be a cash outflow. So we need to subtract this amount of 54,000. And that's all for our final section as well. So that's 54,000 we need to subtract because these are the dividends paid. Okay, let's calculate the net cash from financing activities. That's going to be 100,000 plus 50,000 plus 30,000 minus 54,000, which results in a total of 126,000. Now we need to figure out the net increment or decrement in our cash and cash equivalents. So for this, we just need to add the net cash from operating activities, net cash from investing activities, and net cash from financing activities. In this case, that's 162,000 minus 277,000 plus 126,000, which results in positive 11,000. So since this is a positive amount, this is the net increase in cash and cash equivalents. Okay, then we need to add our opening cash and cash equivalents to our net increase, so that we get our closing cash and cash equivalents. Okay, let's have a look above. We are given the opening bank balance to be 17,000. And after making an adjustment, our closing cash and cash equivalents will just be 28,000. Alright, this concludes our corrected statement of cash flows for the year ended 31st December 2022. And we were given the working section right here. So you need to show all of the workings for these three information within that particular box in order to get your markings correctly. Now we're given additional information. The directors expect that as a result of the expansion of the business, investors will see changes in some of the company's investment ratios in the coming year. Discuss without making calculations why the following changes might take place. Okay, we first need to consider a decrease in earnings per share. So earnings per share is just our net profit divided by the number of ordinary shares. And we need to discuss why this ratio will decrease. So for the decrement in earnings per share, we require either the net profit to decrease or the number of ordinary shares to increase. So the very first reason that we can see is that the increment in net profit might be less proportionate than the increment in the number of shares. So an increment in profit is less proportionate to the increment in the number of shares. The next thing that we can write down is, remember we had an increment in the bank loan of 30,000. So the bank loan will have increased our interest charges that will reduce the profit. So we can write that down. The bank loan will increase the interest charge, which reduces profit. And remember, we also purchased new machineries. So we can say that those machineries of non-current assets will take time to turn into increased profits. So investment in new non-current assets will take time to turn into profit increases, because we cannot really have an immediate effect on profit by purchasing new machinery. It will take some time. Okay, that's all for the first part. Now we need to consider the increase in price earnings ratio. So price earnings ratio is just the market price per share divided by the earnings per share. And we're talking about its increment. So either the market price per share should increase or the earnings per share should decrease. So the very first thing that we can write down is we are expecting our earnings per share to decrease, which will result in increment of the price earnings ratio. So earnings per share is expected to decrease which will result in increment of price earnings ratio. Further, our company is focusing on expansion. So this expansion might result in increment in confidence within investor, which might result in the increment in market price per share. So the increased confidence of shareholder due to the expansion plan result in an increased market price per share. Okay, now for the third part, we need to consider decrement in dividend yield. The dividend yield is just the dividend per share divided by the market price per share. And we're talking about its decrement. So either our dividend per share should decrease or the market price per share should increase. And we already know that the confidence or the increased confidence of shareholders due to the expansion plan will result in an increased market price per share. So we can utilize the same reasoning here as well. The increased confidence of shareholders increases the market price per share and we need to talk about the dividend per share as well. Remember, we made a bonus issue of 300,000 shares as well as the rights issue of 100,000 shares. So maybe the increased number of shares might have caused the dividend per share to be lower. The increased number of shares may cause the dividend per share to be lower. Okay, that's all for this part. Now we are given additional information. The directors are considering making another bonus issue of ordinary shares in a year's time. We need to advise the directors whether or not another bonus issue would be beneficial by justifying our answer. So bonus issue is a way of rewarding our existing shareholders, which means that this bonus issue of ordinary shares might help keep the shareholders happy. Let's write it down. It might help keep shareholders happy. But remember, bonus issue should be funded by our reserves, which means that this will further deplete our reserves. It will further deplete the reserves. Now, based on these factors, you need to advise the directors. So personally, my decision would be that another bonus issue would not be beneficial because this will result in the increment of number of shares. So the increased number of shares will cause the dividend per share to be lower, which means that our dividend yield will be further decreased. And the increased number of ordinary shares will again result in a decrement in earnings per share as well. So that would be my reasoning. Let's write it down. Another bonus issue would not be beneficial as it would further decrease the dividend yield and the earnings per share. Okay. This completes question number 3. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.